Welcome back, guys. So today we are going to be talking about different chart patterns and candlestick patterns, which is very important for your trading journey, especially if you're a beginner. Even if you're advanced and you want to sharpen some few things which you don't yet know, then you're welcome to this video. So today we are going to be seeing some of these chart patterns and candlesticks, as well as real life scenarios. Okay, so the first on the list that we're going to be looking at is how normally a candle looks like. Okay, in every chart you open, be it whether you're trading forex, crypto, or stocks, you'll definitely find a candle that looks like this. Okay, as you can see, this represents the body of the candle, and this other side, which is also called the wick, it's called the upper shadow as well, and the one below is actually called the lower shadow. I'm going to explain this side of things in the upcoming charts, because when you have a bullish candle is always represented with the color green, and a bearish candle is represented with the red color in most charts. So if you have a bearish candle, then you're going to have this setup where this wick is going to be called the high, and this lower shadow is going to be called low. The same thing applies for a bullish candle as well, but for a bearish candle here, this is where the candle actually opened. When we say open, that means this is the initial starting position of that candle. Okay, and this is where the candle closed. This other side of the candle simply shows that the sellers were really pushing through. The sellers pushed through to this end, but were not able to sustain it, and buyers actually pushed back. And likewise, this other side of the wick, it actually shows that buyers pushed to this end, but sellers were actually dominant in the market than the buyers. Okay, so one of the first structures I want us to be seeing is like we have a bullish candle, or when buyers are actually in control, and we have a bearish candle, the red one, when sellers are actually in control. As you can see, as it's well labeled here, we have the body of the wick. We have since the bullish candle, you can see that that's where it opened. The bullish candle opens at the bottom, okay, and closes at the top. Forget about what you're seeing here as of now. It opens at the bottom, okay, for a bullish candle. It opens at the bottom and closes at the top, okay, and these are the wicks. The end of the wick is always called the high and the low. The same thing applies, okay. So we're going to be seeing some of those things in the upcoming videos as well. So now, one of the candlesticks that you should be actually watching out for is a doji candle. Okay, whenever you see a doji candle, it can be a bearish doji candle, or a bullish doji candle, or a bearish doji candle. As I explained earlier, what this signifies is buyers actually pushed through to this end, but yet sellers, they pushed through up to this end even, but sellers actually took over. So it's important, okay. And this is how you have to identify. Don't be moved by the name. Just try to understand what they do represent. It's going to help you when making trading decisions as to enter a position or not while you're trading. Okay. Now the next switch we have here is the hammer. Okay. We have two types. We have there's the bearish hammer and there's the bullish hammer, and we equally have the inverted hammer as well. So the reason for the name, as you can see there, it just simply looks like a hammer, like a physical hammer. That's why the name was given. So you can see, since this is actually a bullish hammer here, you can see it opened at the bottom here and then closed at the top. The reverse is for the other. So this is the opening stage and this is the closing actually of the candle. Okay, so it's very important that we take these notes. In case you're wondering what's happening, you can always revisit the video, or you can come to this website called Pepperstone, where they have insights to some of these details, and you see them for yourself. Okay, like this, how you can identify them while trading yourself. You can see we're in the downtrend. I'm going to be explaining what these trends do mean. You can see that here this is giving a buy signal. If you see a bullish hammer, definitely is giving you a buy signal, and if you see a bearish hammer, is giving you a sell signal. So it's very important that we know that, okay, equally known as hangman, as you can see there. So we have a shooting star. Here's the next one, a shooting star. It's similar to the hammer, but the difference is the body of the candle is actually much more smaller, okay, and it's at the edge of it. Similarly, as you can see, this is the inverted hammer that we see here. So it's quite basic. You can always come to the charts here and then you try to see some of these things. So we're going to be going into TradingView to actually see in real case scenarios how to see some of these and spot them in the market while trading, because sometimes when clearly depicted, it's quite easy to see, but when you're on your own, sometimes it can be challenging to spot. But if you study, then it becomes easier to see. Okay, so we have also the bullish engulfing candlestick. So for instance, it appears you can always identify if a candle is a bullish engulfing or a bearish engulfing if there are two candlesticks available. You cannot do it with a single candlestick. So whenever a bullish candle or whenever a bearish candle actually closes above the previous candle, which was a bullish one, then you can say that, which was a bearish one or a bullish one even, then you can say that that's actually a bullish engulfing candle. As you can see, this particular candle closed above this one. Okay, so you can see here that they're not at the same level. So it's very important. That's why it's bullish engulfing, like it completely closed it. So that's what it means. And we'll have equally a bearish engulfing. Now we see the red candle that opened and closed below it. Okay, completely engulfs this, takes over it totally. So that's what we have to see. We equally do have the morning star. The morning star, you can identify it when the three candles are such, and you see a candle that looks so similar to this. Okay, the body is quite there. In some cases, might be so tiny, but it's actually at the center between the highs and the lows, and that's how it looks like. Okay, so this actually gives a much more bullish perspective than a bearish perspective. It actually gives us the understanding that buyers are taking control over the market. Okay, so this is an example to see it in a way. This is another candle called evening star. Okay, the morning star actually gives us insights for bullish movement, and the evening star gives us insights for bearish movements. Okay, so it's important for us to know that. As you can see, we have a green candle and a red candle, and it's just hanging there at the top. Similarly, we have a red candle and a green candle, and this morning star is at the bottom. All right, so that's one thing we ought to note. Now, with that being said, that equally, before going into the live charts for us to actually identify some of these things, okay, maybe I might be going too fast. You can always rewatch the video to get more insights. Before going to the charts to actually identify some of these things in real life scenarios, let's look at some chart patterns which you should definitely be looking out for as a beginner trader or even an advanced trader. You should be able to spot at least what's taking place by these charts. Even though the chart should not be your confirmation for entry, but it should give you insights before you take any position you're taking. And not before going to the charts, let's look at some of these other candlestick charts. For instance, this is something very similar. This particular candle is like a dragonfly. This gives a lot of insight into positions, especially when you see this on higher time frames. I'm going to talk to us what higher time frames mean when we get to the charts. This actually gives us a lot of insight. It's called a dragonfly. Here, if I'm to explain what actually took place here, it simply means sellers were about gaining control, where buyers took over with a milestone. Okay, so here there's kind of like an equilibrium, and you can see this is a high. It shows here open, close. Okay, the same thing here as well. Open, close. Similarly, open, close. As you can see that there. So this is the high, this is the low. High, low. Always the same. But the opening and closing is different based on if it's a bearish candle or it's a bullish candle. If it's a bearish candle, definitely you're always going to find the openings at the top and the closings at the bottom. If it's a bullish candle, you're going to always find the openings at the bottom and the closings at the top. So have that in mind. So there are some patterns that we have to learn how to understand. And before going to patterns, then we have to understand some trends. Okay. Now, whenever we're on the uptrend here, whenever we see the markets are in an uptrend, it simply means that we have successive higher highs being broken. Okay, this is a higher high and this is a lower low. Okay, the names might be confusing, but just take it the way it is. Okay, whenever markets pull back and then this zone was actually broken, okay, it formed a higher high and we had a retracement, and then this same zone was broken, definitely we had another higher high here. So consecutive higher highs are being formed and consecutive higher high structures are being broken. So this is a higher low, another higher low, and this is a low right below here. And the reverse is true for a downtrend. Okay, now we see consecutive lower lows are being disrespected, are being broken. Another lower low structure is being broken. Okay, and we have lower highs being formed. Okay, so that's what the trend simply means. You can depict them with trend lines, but one of the best ways to identify them is when you actually see higher highs being broken or lower lows being broken. Okay, So it's very important for us to note some of these. And we equally have, as you can see, resistance, support. Okay, so resistance are always at the top, while supports are at the bottom. We're going to see more of this as we move into the charts. Right, if I'm moving so fast, then you can always come back to the video and watch some of this. Okay, so we have some patterns called the head and shoulder. Okay, so if you look at this pattern so closely, this looks like the head of it, this is a shoulder, and these are some other shoulders here. Okay, like this is, you can just picture it like this is somebody's head, and then this is his or her shoulder right here, and then this is the neckline. Okay, so take note of these terms: the neckline, the head, and the shoulder. We're going to see how this applies when we are about to start trading. You probably have some patterns now, like a double bottom, or say double bottom. This at the level of support, we can see market came to these structures, to this particular structure twice. So it's actually called a double bottom, and the distance to the neckline is the distance before it got here to the previous level is called the neckline. Okay, so that's what we have to understand. The reverse is true as well. When we have a level of resistance and we have two tops there, then we have a double top. So it's important. You probably have this a bearish triangle. This is actually a bearish triangle, and this is a bullish triangle. We are going to see some of these terms shortly as we move. So before entering the charts, this is one side of things I want us to see. I'm moving fast because I want us to see this. You can rewatch the video. So we're going to be going to the charts to see some of these things as they are on the charts. It's quite easy to spot them when they are being drawn like this, but on the charts they actually look a little different than this. Okay, so this is a double bottom. I think I explained this. You have the head and shoulder. I see this can be seen as the head and the shoulder, another shoulder here, and this is the neckline. Okay, now we equally have a rising wedge. When you see markets going in this pattern, okay, before when it breaks, it starts going back downwards. We equally have the double bottom, which we saw previously. This is the invert, you can call it the inverse head and shoulder or the inverted head and shoulder. The same thing, it's just the reverse of this. Similarly, double top, double bottom. Okay, the reverse, and the reverse of this also we have the falling wedge. Similarly, let these patterns get into your mind. Whenever you open any chart, you should just be able to identify these things without even drawing any lines, but you can always draw lines before seeing them. It's important. As a trader, this must be embedded in you. If you don't have this, then you're already set for some downfalls. This is not what you use to enter positions. You can develop your strategies around this, but this is not what you use to enter positions. But they have to be embedded within you because they give you directives as to where markets are moving. So it's very important. Let's see some more patterns. Okay, we have the bullish rectangle when market is consolidating, or this is a consolidating market. We have a falling wedge, okay, and we have a rising wedge. Okay, we probably have a bullish pennant, similar to the falling wedge in a way, or kind of a bullish flag. Those are similar terms to it. I equally have a bearish flag or pennant, the same thing. Okay, and this is a bearish rectangle. So what's the difference between the bullish rectangle and the bearish rectangle? If we're in an uptrend and the market started consolidating and it's about to break, then we're in the bullish rectangle. And if we're in a downward trend and market started consolidating and we're about breaking to go down, then we're in the bearish rectangle. Okay, so sometimes you probably have triangles, ascending triangles. Okay, not a falling wedge, not a rising wedge. Okay, an ascending triangle. We'll see some of these, and a descending triangle as well. We would equally have a symmetrical triangle. This symmetrical triangle, you can see these ones are kind of pointed. This one is pointed downwards, the other was pointed upwards, but this one is kind of at the center, right? So with this in mind, try to have this in your mind while you're trading, or while you're on any chart. Try to identify this for them to give you insights as to the direction of the market. So let's try to move over to TradingView and try to see what's taking place here. Okay, so in part of the slide, you can see this already a level of what? Resistance. Okay, if I should move this to the bottom here, we can see this is a level of support whenever the market came to this point several times. Okay, and I actually spoke on the time frames. So if you're on TradingView, for instance, whenever you click on this W here, or maybe you click on this arrow here, and you're going to see different time frames. So whenever you click on 1 minute, the charts are being rearranged in such a way where every candle represents a minute. Okay, so since I'm on the 1 week time frame, it simply means every candle here represents 1 week. It took 1 week for every candle to be formed. Okay, so this is a very long duration of time. So sometimes you're on the weekly time frame to spot direction, or if you're a swing trader, a trader that actually wants to trade for longer periods of time, then you should be trading on these time frames. But if you're a scalper, you should be coming to these time frames to actually get direction for where you're going to, where the directions of the market is telling you that it's going to start moving towards. Okay, so now if you look closely, we spoke of a double bottom. You can see here similarly, this is similar like a double top. Okay, this is similar like to a double top here, as we saw in the previous chart. If we want to look at some other patterns, like let's see, the is something similar to the rising wedge. Is something similar to the rising wedge which we saw. Okay, and sometimes to draw your trend line, it should not be too steep, but it should actually be able to touch at least 2 to 3 points. Okay, on your charts, like we have 1, 2, and the third one. Okay, so you can see that it gives us an upward trend. Okay, and now also I'm explaining so many things in the same chart for us to see. Also, if you want to be able to see if we're in an upward trend, so you can see if this is a low, now this is a high, now this is a lower low, so now this is a higher high, because this structure was broken. It came, formed what? It formed a low, then broke the previous higher high, formed a new higher high, then now formed a what? A higher low, and this other higher high was broken, then we now form another what? Higher high. So this is how you can depict what? An ascending, like an upward trend. It's very important for us to know that. The same is true for a downtrend, so you can do the same thing. So without drawing trend lines, this is how you can be able to see if we are in an uptrend or a downtrend. In some charts, you might not be able to draw a trend line, but it actually does have a trend line. Okay, so it's very important for us to know that. And this one, another chart pattern we saw that was quite there. This one pattern we quite saw, and I think this one is going to be the, how do we call this? This is definitely going to be the descending, no, this what's the name? The bearish flag. Exactly, this is a bearish flag. Why is it called a bearish flag? Because if I'm to draw a line here, this looks like a flag that was just inverted. This is how the names are given to them. There's nothing special about the names. It's all about how you can easily name them when trading. So whenever you see something like this, it should help you, give you insight to what's happening. So in the subsequent videos, I'm going to be showing us the strategies that we should use to trade, and not necessarily be all around these many different strategies. I'll teach us and why that one is quite convenient as we move along. So with that being said, you can always come back to some of these patterns which we've spoken of. You can always come back to some of these patterns. As I said before, you can always get to the website pepperstone.com, and then you get there, you find some of this insight and work with them. So it's very important for you to know this. Let these patterns be within you. As I said, it's not necessarily for entry, but it's mostly for directions to where markets are going to. All right, so try to find it out. You watch this video, and don't forget to like, share, and subscribe for much more details. Okay, thank you for watching.